$400 a month. That's what Dorothy Sinclair, 64, from Knoxville, Tennessee, was leaving on the table every single month for 11 months, $4,400 total, because nobody at her local Social Security office told her about SSA Form SSA-561-U2. Dorothy had filed for survivor benefits after her husband passed in January 2024. The office approved her claim, mailed her a letter confirming her monthly amount, and she accepted it. Why wouldn't she? That number was wrong. It was $400 below what she was legally owed, and the only way to fix it was a single one-page form that 71% of eligible seniors never file. If you're over 60 and receiving any type of Social Security benefit, retirement, survivor, spousal, or disability, the next 26 minutes could put up to $4,800 back in your account over the next 12 months. And I'll show you the exact form, the exact line, and the exact words to write that force the SSA to recalculate. Here's what makes this so dangerous. The Social Security Administration does not voluntarily recalculate your benefit when they make an error in your favor. Read that again. They recalculate instantly when they overpay you, garnishing future checks, sending threatening letters, demanding lump sum repayment. But when they underpay you, silence. The system relies on you not knowing that Form SSA-561-U2, the request for reconsideration, exists. It relies on you trusting the number they printed on your award letter. And for 6.2 million American seniors right now, that trust is costing them between $147 and $612 per month in benefits they've already earned. Let me tell you exactly who this affects and why, because this isn't a universal problem. It's targeted. The seniors most likely to be underpaid share 3 specific characteristics, and I'll walk you through each one so you can determine in the next 2 minutes whether you're one of them. Characteristic number 1. You worked for at least 10 years but had periods of low or zero income between ages 45 and 60. The SSA's primary insurance amount formula uses your highest 35 years of earnings. If you have fewer than 35 years of substantial earnings, they insert zeros into the calculation. Nothing controversial there. That's published in SSA Publication 05-10070. But here's where the errors creep in. When the SSA's automated system pulls your earnings record, it sometimes misattributes years. A year where you earned $38,000 gets recorded as 0 because of a clerical mismatch between your W-2 and the SSA's master earnings file. Karen Whitfield, 67, from Sacramento, discovered that her 1998 and 2003 earnings, totaling $61,400, were simply missing from her record. That omission dropped her monthly benefit by $389. She found it by requesting her earnings statement at ssa.gov/myaccount and comparing it line by line against her old tax returns. Characteristic number 2. You transitioned between jobs or moved between states during any year between 1985 and 2005. The SSA's older record systems experienced documented data migration issues during 3 specific periods: 1989, 1997, and 2004, when earnings records transferred between regional processing centers. A Government Accountability Office report from 2007, GAO-07-672, confirmed that approximately 9.4 million earnings records contained at least one discrepancy tied to these migrations. Some tax professionals say this problem was resolved by 2010. Others point to ongoing discrepancies their clients still discover today. The SSA hasn't publicly acknowledged the scope since that 2007 report, but the errors remain embedded in millions of active benefit calculations right now. Characteristic number 3. You filed for benefits within 60 days of a major life event, a spouse's death, a divorce finalization, or a disability onset. When claims processors handle these emotionally charged cases, the error rate climbs, not because they're careless, because the workload is crushing. The average SSA claims specialist processes 34 cases per day with a target completion time of 22 minutes per case. 22 minutes to calculate a benefit amount that determines your income for the rest of your life. Mistakes don't just happen. They're statistically inevitable. I'd be curious to know, have you ever compared your earnings statement against your old W-2s or tax returns? Because in the comments on videos like this, hundreds of viewers discover discrepancies they never knew existed. Some find one missing year, some find 3. Now let me walk you through exactly what Form SSA-561-U2 does, because this is where most people get confused. They hear request for reconsideration and think it's an appeal, something you file when you've been denied benefits entirely. Wrong. The SSA-561-U2 serves a dual purpose that almost nobody explains correctly. Yes, it's the official appeals form for denied claims. But Section 4 of that form, specifically the checkbox labeled Amount of Benefit, allows you to challenge the dollar amount on an already approved claim. You're not appealing a denial. You're telling the SSA, you approved me, but the number is wrong. Here's why. Recalculate it. Donald Greer, 72, from Fort Worth, Texas, used this exact process in September 2024. His retirement benefit was set at $2,180 per month. After comparing his earnings statement to his tax records, he found that $44,000 in self-employment income from 2001 and 2002 was recorded at $0 on his SSA record. He filed the SSA-561-U2 with copies of his Schedule SE from those years attached. The reconsideration took 74 days. His new monthly benefit, $2,571. That's $391 more per month, and the SSA owed him $4,692 in retroactive payments for the 12 months they'd been underpaying him. One form, one filing, $9,384 in the first year alone when you count both the retro payment and the ongoing monthly increase. Wait, it gets worse. Because here's what most people don't realize about the timeline. Under SSA Program Operations Manual, Section GN 04001.010, you have exactly 60 days from the date on your initial determination letter to file the SSA 561-U2 without additional requirements. After 60 days, you can still file the SSA will accept it, but they may require what's called good cause for late filing. Good cause includes showing that you didn't understand the determination, you received incorrect information from an SSA employee, or you had a physical or mental condition that prevented timely filing. For seniors over 60, that third option almost always applies. You can cite health complications, caregiver responsibilities, or lack of clear communication from the SSA. Depending on which district office reviews your case, the approval rate for late good cause filings ranges from 61% to 89%. Some offices are lenient, others require more documentation. The form itself is one page that could change your monthly income permanently. Here's exactly how to fill it out so it doesn't get kicked back or delayed. Line 1, your name, social security number, and claim number. Your claim number is on every letter the SSA has ever sent you. It's your social security number followed by a letter suffix. For retirement benefits, that suffix is usually A. For survivor benefits, it's typically D or E. Line 2, the type of claim, check retirement or survivors or whichever applies. Line 3, the date of the determination you're challenging. This is the date printed on your award letter or benefit verification letter. Line 4, this is the critical line, check amount of benefit. Not entitlement to benefits, not anything else, specifically amount of benefit. Then comes the statement section. This is where 90% of people fail. They write something vague like, I think my benefit should be higher. That tells the SSA nothing. Here's what you write, and I want you to save this exact language. I am requesting reconsideration of my benefit amount. My primary insurance amount does not accurately reflect my lifetime earnings. Specifically, my earnings record at SSA shows $0 for the year, where it's insert years, while my IRS tax records, copies attached, confirm earnings of insert amounts. I request that my PIA be recalculated using my corrected earnings record per 42 U.S.C. Section 405C5C, which permits correction of earnings records at any time. That statute citation, 42 U.S.C. Section 405C5C, is your weapon. It's the federal law that says the SSA must correct your earnings record when you provide evidence of an error, regardless of how many years have passed. Most people don't cite it. When you do, your file gets flagged for senior review, rather than sitting in the general processing queue. If any of what I've explained so far made you pause and check your own numbers, and it should have, hitting the like button takes 1 second, and it tells the algorithm to push this video to other seniors who are quietly losing hundreds a month without knowing it. That 2-second action might reach someone's parent or grandparent before the next monthly check hits their account $400 lighter than it should be. Now here's where this goes from a simple form submission to a full financial recovery, because finding missing earnings isn't the only reason your benefit might be wrong. There are 3 other calculation errors that affect seniors over 60 at alarming rates, and the same form fixes all of them. Error Type 2. Incorrect application of the windfall elimination provision. The WEP affects anyone who worked for a government employer, federal, state, municipal, or school district, that didn't withhold Social Security taxes, and who also worked enough years in Social Security-covered employment to qualify for their own retirement benefit. The WEP reduces your Social Security check. That reduction is legal, but the formula has a cap. The WEP cannot reduce your benefit by more than 1/2 of your pension from non-covered employment. Thomas Belmont, 69, from Phoenix, Arizona, worked 18 years for the Arizona Department of Transportation, then 14 years in private industry. His state pension is $1,700 a month. His Social Security benefit was calculated with a WEP reduction of $587, but 1/2 of his state pension is $850, so $587 is technically within the legal limit. However, the SSA used 18 years of non-covered employment in their calculation. Thomas actually had only 16 qualifying years because 2 of those years, 1991 and 1992, his employer did withhold FICA taxes during a brief policy change. That miscounting changed his WEP factor from 0.45 to 0.55 on the first bend point. Net result, his benefit should be $213 higher per month. He discovered this by requesting his detailed benefit calculation, Form SSA 7050, Request for Social Security Earnings Information, and cross-referencing it against his pay stubs from those 2 years. Error Type 3. Failure to apply the special minimum benefit. This one is almost never discussed. If you worked for at least 11 years in Social Security-covered employment where your earnings exceeded a specific threshold, $16,213.50 per year for 2024, you may qualify for the special minimum PIA under Section 215A(1)(c) of the Social Security Act. For someone with 30 or more years of coverage above that threshold, the special minimum benefit in 2025 is $1,066.50 per month. If your regular PIA calculation produces a number lower than that, common for people with many part-time years, the SSA is supposed to automatically apply the special minimum. Supposed to. Margaret Dunn, 73, from Columbus, Ohio, had 28 qualifying years. Her regular PIA produced $987 per month. She should have received the special minimum of approximately $1,033 instead. Nobody told her. She lived on $46 less per month for 4 years before her daughter, a paralegal, caught it. That's $2,208 stolen by bureaucratic neglect. If you've stayed this far into this video, you're clearly someone who refuses to let the system shortchange you or someone you love. Subscribing means you'll see the follow-up video I'm releasing next week on the 5 SSA letters that seniors throw away without reading. Because one of those letters is a pre-reduction notice that gives you exactly 30 days to respond before your check drops permanently. That video connects directly to everything we've covered today. Error Type 4. Miscalculated cost of living adjustments. The COLA is applied to your primary insurance amount every January. In 2023, it was 8.7%. In 2024, 3.2%. In 2025, 2.5%. These percentages compound. They're applied to the prior year's adjusted number. But here's where computation errors hide. If your initial PIA was wrong, every COLA since your filing date was applied to the wrong base number. The underpayment grows every year. For someone who filed in 2020 with an initial PIA that was $200 too low, the compounding COLA error means they're now underpaid by approximately $247 per month, not $200, because 5 years of COLA adjustments stacked on the wrong foundation. This next part sounds technical, but don't skip it. 90 seconds of understanding this could mean the difference between recovering 3 years of back pay and recovering nothing. When you file the SSA 561U2 and win your reconsideration, the SSA owes you retroactive benefits. But how far back do they go? Under current SSA policy, retroactive corrections based on earnings record errors go back to the date of the original error, potentially decades. That's different from standard retroactive benefits for new claims, which are capped at 6 months for retirement and 12 months for disability. Earnings corrections are treated differently because they fall under 42 U.S.C. Section 405, C5, which has no time limit for correction. However, and this is the uncertainty that even SSA employees argue about, some district offices interpret correction as only affecting future payments, while others apply the correction retroactively with full back payment. There's no uniform policy enforcement. Your outcome may depend heavily on which office processes your case and which policy interpretation they follow. So how do you tilt the odds in your favor? You include one additional sentence in your SSA 561U2 statement. I request retroactive correction and payment of all underpaid benefits from the date of initial entitlement per GN 04001.060 and POMSRS 0060.5.360. Citing those internal SSA program operations. Manual sections signals that you understand their own procedures, and that makes your case harder to dismiss with a form letter. Now here's what nobody connects about this process: the earnings record error, the WEP miscalculation, the special minimum failure, and the COLA compounding. They don't exist in isolation. If your earnings record contains an error that understates your income, that same error can trigger an incorrect WEP calculation by changing your years of substantial earnings count. And if your corrected PIA crosses the special minimum threshold, you're entitled to a completely different benefit formula. One error corrected can cascade into 3 separate upward adjustments. This is why filing the SSA 561U2 with thorough documentation isn't just about one missing year of income. It's about forcing the SSA to rebuild your entire calculation from the foundation up. The system wasn't built to double-check itself on your behalf. It was built to process volume, 70 million beneficiaries, 5.9 million new claims per year, 1,200 district offices operating with 12% fewer staff than they had in 2010. Every shortcut in that system costs someone money. And that someone is statistically most likely to be a senior between 60 and 74 who filed during a high-volume period and never looked back at the numbers. Here's your action plan. Monday, log into ssa.gov/myaccount and download your earnings statement. Print it. Tuesday, pull your tax returns from every year you worked. Focus on any years showing $0 on the SSA record and any years you worked for a government or municipal employer. Your old returns are available from the IRS using Form 4506-T, which you can submit online at irs.gov/forms-pubs. Wednesday, compare the two documents line by line. Circle any discrepancy, any year where the IRS shows income and the SSA shows 0 or a lower number. Thursday, if you find a discrepancy, download Form SSA-561-U2 from ssa.gov/forms/ssa-561.pdf. Fill it out using the exact language I gave you earlier. Attach copies, never originals, of your tax returns, W-2s, or Schedule SE forms for the disputed years. Friday, submit it at your local SSA office in person if possible. In-person submissions are date-stamped immediately. Mailed submissions can take 7-10 days to be logged, and that matters if you're close to the 60-day reconsideration window. One more critical detail. When you submit in person, ask the representative for a receipt showing the date filed and your confirmation number. If they say they don't provide receipts, respond with these exact words. I'd like a notice of receipt per P. OMSGN 03-102.100. That internal reference requires them to provide written acknowledgement. Without that receipt, your filing can be lost in the system, and you'd have no proof you submitted within the 60-day window. That receipt is your insurance policy. Dorothy Sinclair, the woman from Knoxville I mentioned at the start, filed her SSA-561-U2 on November 3, 2024, after discovering that $28,000 in earnings from 1999 was missing from her record entirely. Her husband had handled all their finances before he passed, and she'd never checked her own earnings statement. It took 81 days for the reconsideration to process. On January 23, 2025, she received a revised determination letter. Her new monthly survivor benefit, $2,114, up from $1,717. That's $397 more per month. The SSA also deposited $4,367 in retroactive underpayments directly into her bank account, covering the 11 months between her original filing and the correction. One form, 1 hour of comparing documents. $9,131 recovered in year 1, with nearly $4,800 more every year going forward for the rest of her life. You worked for decades to earn those benefits. Every paycheck had Social Security taxes pulled from it. 6.2% of every dollar you earned, every pay period, for your entire working life. That money bought you a promise. If the system broke that promise through a clerical error, a missing record, or a rushed calculation, you don't accept the lower number. You file the form, you force the recalculation, you collect what's yours. In the next video, I'm covering the 5 specific bank account moves that trigger automatic SSA benefit reductions, and one of them is something nearly every senior does the week they receive their first Social Security deposit. If you thought today's form was hidden, wait until you see what the SSA's Internal Operations Manual says about income deemed from financial assets. That video drops Thursday. The government keeps meticulous records of what you owe them. Start keeping the same records of what they owe you.